Crypto exchanges do not only compete with each other now, more and more they are starting to compete with traditional markets, and Bybit is one that is pushing very hard in that direction. Recently they added 50 more US stocks to their TradFi platform, and also made it much easier to access and trade conventional markets via the exchange. So if you want to take a break from trading crypto, or just expand your trading arsenal, in this video we're going to explain what Bybit TradFi is and how to use it. So don't forget to subscribe, hit the bell button, and let's get started. So TradFi is Bybit's platform for traditional assets. There you can trade stocks, indices, forex, and even metals and commodities. It's been operating for a couple of years already, but for a long time to access traditional markets on Bybit you had to download a separate client. Now, however, it is directly accessible via Bybit's web interface and mobile app. Inside you will find the same trading interface as on spot or futures. First of all, to start trading you will need to create a TradFi account. You can do it directly from the terminal, by simply clicking this button, and then accepting the agreement. And if you don't have an account on Bybit itself, you can use the link in the pinned comment under this video. This way you will be able to get the maximum welcome bonus from the exchange. After signing up, you will need to transfer the funds for trading. You can also do it right here in the terminal. The funds can be transferred either from your main trading account or from your funding account. As a currency, TradFi uses the USDT token. The transfer is not instant, you will need to wait a couple of minutes. You will also notice that your funds here are displayed as USDX, but it is not a separate currency and your money is not converted to anything. It's just an internal display unit, which reflects your USDT balance at a 1-to-1 ratio. Now let's talk about what TradFi is all about. In fact, it's kinda similar to futures trading, and here's why. All the available assets on TradFi are represented by contracts, so you don't buy the assets themselves, but rather speculate on price movements, the same as on crypto futures. But there are also quite a few nuances, which we'll explain in this video. First of all, let's choose a contract and open its info page. First of all, here we see the latest buy and sell prices for a single unit of this asset. And spread is the difference between those prices, which you essentially pay when you enter a trade. The contract size represents how many units of this asset are included in the contract. For stock contracts it's quite simple, one contract equals one stock. But in other categories, like the gold contract here, one contract may include a few dozen or even a few hundred units. Now, the trading volume on TradFi is measured in lots. A single lot represents one contract. Since contracts have different sizes, to know the price of a single lot, you need to multiply the current price by the contract size. In the contract info you can also see the minimum and maximum order size in lots. As you can see, the minimum here is lower than 1. So if a contract is expensive, for example, you don't necessarily need to buy a full lot. The next important parameter is the leverage. Unlike crypto futures, on TradFi you cannot manually change the leverage. It is already preset for each contract. Here on gold the leverage is 500, and on stock contracts, for example, it's set at x5. For most of the contracts in the info you can also see the margin requirement. It determines how much of your funds is required to open a trade and maintain the position. Here, for example, the requirement for regular sized orders is 0.2% of your total order size. This is how it works for most contracts. For stock contracts, on the other hand, there is no specific margin requirement, but you can deduce the required margin for your trade by simply dividing the total order size by the contract's leverage. Now, there is more regarding margin that we need to discuss. For this, let's enter a test trade. For our test trade, we chose the Nvidia stock. On TradFi you can use two types of orders, a simple market order and a trigger order. For simplicity, let's choose the first one. To set the order size, you can either choose how many lots you wanna buy, or set a specific USD value. But note that lots are still the primary measurement unit, and there is a specific minimum step size, which you can find in the contract's info. Here, for example, the step size is 0.1 lots, so in some cases, if you just type in the USD value, it might be rounded up to an appropriate lot size. So in our case, one lot costs $224. So if I set the USD value to 225, for example, the final order size will still be one lot, because the increase is lower than the minimum step size. Before placing your order, you can also set a take profit and a stop loss, which we recommend that you do. Now let's finally enter the trade. After that, your position will show up below the chart, where you can manage it. And below the order menu we can find the account details. Here you can see the amount of margin that is used in all your current trades, and also the free margin that you can use to open new ones. But the more important metric here is the margin level. This is the main risk indicator on TradFi. It shows that you have enough funds to maintain your position. If it's above 100%, the risk is relatively low. It means that your total equity, which is your account balance plus unrealized profits or losses, is more than the total margin used for your positions. But if it starts to drop below 100%, this is not very good. This is because the liquidation process on TradFi is different from crypto futures. First of all, there is no isolated margin mode. The TradFi margin system is more similar to cross margin, meaning that all your positions use your total equity as a shared margin pool. But liquidation still works differently here. The liquidation process starts when your margin level drops below 50%. When this happens, the system starts to close your trades one by one, starting with those with the biggest losses, and keeps doing it until the margin level rises above 50%. So you need to watch it carefully, and better not allow it to even drop below 100%. Now, another important feature of TradFi is that markets do not work 24/7 like crypto. The working hours are different for different contracts. Some, like stocks, work for almost full 24 hours, but only on work days. For others, the window when trading is open might be even smaller. You can find the schedule for each contract on its info page. Here you can switch to your local time to better orient yourself. Apart from markets not being always open, there is also an additional fee, which you pay for holding a position overnight. It is called the swap fee. You can find it in the contracts info as well. The swap fees on TradFi are similar to funding fees on futures. There are separate fees for long and short positions, and they can be either negative or positive. There is also a 3-day swap for holding positions over weekends. Now, since we covered that, we also need to talk about the actual trading fees. Under your account's info, you can switch the account modes, which is another relatively new feature on TradFi. By default, you are trading in the so-called zero fee mode. In this mode, the fees are included within the displayed spread, and you don't have to pay a separate trading fee. The second account mode is the tight spread mode. The name speaks for itself. This mode provides the lowest possible spreads, but in return you have to pay a separate trading fee. This mode is designed for professional, high-frequency or high-volume traders, and actually not everyone is even able to use it, because the minimum requirement for using this mode is having at least $3,000 deposited on TradFi. Anyway, most of us will be just fine with the zero-fee mode, especially given the fact that even regular spreads on TradFi are not that big. And to wrap this video up, let's briefly talk about a few additional tools for TradFi. First of all, if you go to Bybit's copy trading section, you'll see the recently added TradFi copy trading. It works pretty much the same as the regular copy trading. You find a trader with a good strategy, which you wanna copy, enter the investment amount, set a take profit and a stop loss if you want to, and just start copying the strategy. Also note that TradFi copy trading uses your funding account instead of your TradFi account, so you might need to transfer funds if you want to use it. And the other new tool is the TradFi trading bot. Technically, it is a rebalancing bot. In other words, it manages an investment portfolio. If you never used one, it basically works like this. You choose several assets for your portfolio and set a specific weight for each asset. When you run the bot, it monitors the asset's weights and, if necessary, rebalances the portfolio. For example, if one asset grows significantly, the bot sells a portion of this asset and redistributes the profit to maintain the required ratio. Also, unlike normal trading on TradFi, with the TradFi bot you can manually set the leverage. And if you don't want to set up the bot manually, you can also use a pre-made AI strategy. If you want a detailed review and guide for this bot, drop us a comment down below, and we will make a separate video about it. And for now, that is all. If you decide to give TradFi on Bybit a try, share your experience in the comments. And also don't forget to subscribe and hit the bell button. Thanks for watching and good trades to everyone.